You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Richard Knowles of Knowles & Associates in Vancouver. He's a financial consultant. He also won the 5-Star Wealth Manager Award as well. Richard, welcome to the show.
Thank you, Jim. Appreciate having you.
Boy, today we're taking a look at the equity markets. Another big correction in the Canadian markets, and they're saying, well, we were due for a correction anyway. They've done nothing but climb. Have they done nothing but climb recently? And is this a problem, or is it just a little blip, or something we should be concerned about?
Well, you know, I invite everyone that has a computer to, while they're listening to the show, or perhaps afterwards to be listening back on this show, to look up the chart of the Toronto Stock Exchange for the last 10 years. It's quite illustrative of where we've been, in any case, at least from the broad index approach. And this is kind of a problem that we have, is that people really, you know, are only looking at snapshots. It seems that we're only going quarter to quarter these days, you know, every 3 months or 4 months we're looking at things, rather than looking at the big picture. And I think it's very important to enter any kind of discussion like this on a big picture overview. And what's really quite intriguing is, while we've been having a bit of a run, the run hasn't been a run up, I should say, in the markets. It has been a very consistent, nice year, starting at around October of last year. So for the last year, we have had a very straight line, almost a straight line up, very little blips, very nice, comfortable run, reflecting a strong economy. However, the reality is that we're riding on the back of a global economy, and we tend to forget this. And I think we have to, if we're investors in Canada and Canadian securities and Canadian investments, we have to acknowledge that our markets are really deeply tied to the markets of the world. So, you know, yes, the world has actually been doing quite well this last year as well. You know, if you're looking at the U.S., you look at Germany, you could look at France, you could look at China. But we've been expecting this correction because it's very difficult to run on high numbers. Now, we're talking about the world right now because Canada has not been running on the same high numbers. Over the last year, it's looking very similar to the rest of the world. But prior to that, we've really been dragging our heels. So if you were looking at this chart, let's say you could pull one up from the Toronto Stock Exchange 10-year chart, you can see that the numbers we're at now on the level of the stock exchange are actually the same numbers, the same level that we would have had in April 12th, 2007. So we've actually gone back in time to that level. Now, prior to April 12th, 2007, we had the big bust of the technology breakdown in the year 2000. But even after that corrected, we've had a very, other than that big bubble, we've had a good average line leading us up to that point in April, of 2007. Then we really started to trade sideways. We really weren't making any major headway. We weren't, straight lining it back up. We did this sort of sideways market movement. And we did that actually until the bubble burst, I suppose you could say, in April of 2008. So we had 1 year of really no gains at all. And then we hit a very nice peak, not much higher than this, but we hit the 15,000 level for the Toronto Stock Exchange, just at the highest point that we had ever seen at that point in June 5th of 2008. And from that point downwards, we had the big slip, the big slide, the big crash of 2008 due to the banking crisis. We dropped to 7,500, 7,500 and change. We had that 74.80, I think, that day. We closed at 75.91 was our close for that day. And that particular point was a precipice drop, and we lost 50% of our value within a couple of months. And the turnaround after that, actually, this is now March 5th, 2009, was the big drop-off, I should say. So in a few months, we were down to the lowest point. We lost 50% of our value within that fall. And from that point upwards, it looks really fantastic. If you could get rid of that chart and just look at it from that point up, you're going, wow, what a nice growing economy. It's the greatest time to have invested. So when you're buying on the lows, they really do make a lot of sense to do a little bit of market timing when you're going to purchase. Now, when you look at the chart even after that, we had this nice big bounce back, but we never hit 15,000 again until, guess when? just about a month ago. We hit the highest point again that we'd had ever. It was back in June of 2008, 2008, and we had not received back that highest point, until the date of June 19th this year. It took us that long to recover to that point in June of 2008. So now that we've hit that point, we started to scale slightly above it, and now that's too much. We've corrected back downwards. In effect, anybody that invested in June 2008 is still in a loss position if you had invested in the ETF of the Toronto Stock Exchange because of this recent sell-off. And in fact, you had been in a loss position this whole time until about a month ago, a few months ago, in June 2014. So that's a phenomenal fact that a lot of people, that sell the idea of getting into ETFs. It's not about necessarily even what you buy. It's the timing of when you buy and what it is important about what you buy, of course. If you've been in bonds the whole time, we'd be in a different discussion entirely. So understanding your risk relationship, if you're dealing with stocks, you're going to deal with, say, an ETF, the Toronto Stock Exchange, or you're going to buy in managed investment funds, you can see significant differences between the two.
So what does this mean to me right now as an investor?
One of the most important things that we've been trying to reiterate in a portfolio development is to deal with international and global stocks and global investments in general. We have all sorts of things going on in the world that are not reflected well in our Canadian stock market. Back in the days, it used to be that we could say that Canada, back in the 50s, was an international player. We had much greater share of the global economy, of the growth of the global economy, simply because we were, relatively speaking, populations had not advanced as much as they have today. So, I mean that certain countries hadn't developed as massive an economy, Russia, China, many of the current massive players in the world today, Brazil, of course the United States, they were all still taking baby steps into the economic global community, even as recently as the 1940s and 50s. So when we say Canada has been held back, in a sense, because of our population growth and our inability to be able to be competitive, it's just simply we just don't have the numbers. We do in oil and some resources, but as we said before in our time here on this station, Canada's a resource-based economy. We trade outward. We sell our goods to the world and our raw resources, but we haven't grown internally. India is another big major player there that's developed because of their population. So when we're looking at mass production, development internal, and even our geographical locations prevent us from development because we're held within this sort of comfortable line above the 49th parallel for the most part, because we can't really easily develop industries in the tundra. There are a few, but really we have no really easily expandable, populations in these areas to develop businesses and to have workshops the way they do in China and other places where you could have massive factories doing things. In the middle of the tundra, when it's minus 80, it feels like, or minus 40 below with wind chill factor. You don't have populations running to these places for jobs unless they're going to be paid, relatively speaking. So this has held Canada back economically. So what we have to do as investors in Canada is we have to look abroad. We have to look elsewhere to make our money. Now, I'm not saying we can't make money in Canada, but you have to be a lot smarter about how you make money in Canada. Buying a broad-based index here in Canada doesn't make sense if you're buying Canadian index. A managed fund has done managed portfolios and managed investments have done far better than the passive indexes over these many years. So, and also going globally is very important. You have to get access to the global markets within your investment portfolios, either global bonds or global stocks, to be able to take advantage of the massive growth markets and growth capital markets and consumer markets, etc., elsewhere in the world. And this is one thing that a lot of Canadians, if you look at the average, there was a study done on Canadian portfolios that showed that very few Canadians, or only a relative few Canadians, and usually only with those with advisors, frankly, the ones that are investing on their own, very few, other than buying in the United States, will have invested anywhere beyond North America at all. And so that's a very important concern as an advisor and as a someone that's an ombudsman on the consumer investment consumer in Canada. And I have a very severe and sincere discussion with clients and anyone I can to ensure that they're aware of the failures in their own portfolios.
We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're talking to Vancouver financial consultant Richard Knowles. You've been saying for months, getting into cash and selling off is a good idea because we're all expecting a correction in October. It's October, and here come the corrections.
Yeah, we've seen a big drop off, and we're going to continue to see it. It's not going away. It's probably going to run another couple of weeks. I wouldn't be surprised if we hit. You're going to hold me. I hope you don't hold me to this one, but I'm guessing based on both a little bit of a technical sell-off, and one thing we can't see is consumer confidence or the short selling situations right now. There being money being made on the downside, making money while it's going down. That's driving a spike into the heart of this correction. It's making it to stopping the correction. In other words, it's making it go down further. I would guess that I wouldn't be surprised if we hit 13,000 at some point in the next couple of weeks. And that's going to be a technical bottom that we'll be hitting. It'll be a good test. And if it dips below that, in theory, it could go further. It depends on what happens on the geopolitical front. But I think just on this basic technical correction, we could see it go down to about 13. I wouldn't be completely shocked if it hit 12, 12.5, maybe even a little lower. But that would be the next level. Would be about 12.1. Would be the next technical level bottom to test, the 12.1 area. But I think that at this point, we're going to probably hit close to 13,000 from the highs that we were at 15 and change. At one point, I think just before the correction started, it was actually at 15,536. So now we're down to, today we're pushing 13.7, and I wouldn't be surprised if in the next couple of weeks it hits 13. So that's a very significant correction, and that would put us into the 15% to 20% correction area, depending on where this stops, and that would be the buying opportunity to re-enter a market if you have cash, depending on the size of the markets, and that's when we're looking at Canada. However, we can't just stay in Canada. When you're looking elsewhere, there are corrections happening all over the globe. And this is the reality: is where and how are you going to be investing your money? Are you looking at, we're just talking stock markets. Think about it. If you were in the bond markets right now, you'd be making some good money because bonds are getting a big lift based on the flight to quality at the moment. People have been selling out and going either into cash or they've been going into fixed income in some way to take advantage of bond, bump ups and the drive to bonds. There's not a lot of action in bonds because the interest rates are so low, but there is capital bump. So if you've been getting in early into the bond market, your fixed income investments in bonds have actually been going up nicely in capital value, not necessarily interest payments, but in capital value because the demand is increasing for that particular type of investment. So there's limited supply in bonds, although there's lots of bonds in the world. Limited supply if everybody's flooding into it all at once. So it gives it a bump up, and that's another play on this market. But if you're in bonds and fixed income, this is a very important time to be establishing rebalancing programs, to be looking at, well, how much should I have in fixed income? Can I weather these storms as long as I have, 30 or 40% in fixed income bonds in some way, shape, and form to offset these kinds of big drops in stock markets? And within my stock portfolio, whatever that is, equities, do I have lots in Canada? Is it overweight in Canada? I mean, where's the best place to be making money? If I'm looking at companies and buying companies and stocks all over the world, where's the best place to do it? And it's an unfortunate situation, but it is important to realize that the value of mutual funds, while they do have also a bad name because people are going, well, I pay fees and things for things. Why not just buy an ETF? Go get your ETFs. I mean, we don't need it. I mean, it's very, very trite to say that and very glib, actually, to be able to make these statements without really looking into the value of things. And one of the things that we have seen is that managed mutual funds have their greatest glory in overseas investing. Yes, it's true. A Canadian equity fund can be replicated quite easily by buying, a set number of 10 to 20 stocks that are big major players on the Toronto Stock Exchange. You could do that yourself. You may not do as well as an index, simply because of when you buy that stock, what have you, but it's not a big brain game to copy the Canadian Stock Exchange index within your own portfolio, depending on the size of the dollars you have to invest. But when we go internationally, I challenge anyone that's a Canadian savvy investor to give me the top 5 names of the major financial banks in Europe or in France, or who's the leading consumer products maker of some company in Europe or in England. And there's great, fantastic opportunities overseas or in Brazil. Tell me the biggest utility in Brazil that you could buy and where you could buy it. Is it available on an easy exchange for you to get to, and how expensive would it be for you to buy? So the greatest and easiest access, especially from a form of liquidity, is buying an international mutual fund that's has a brilliant manager attached to it, that is getting access to this research and knowledge of international investments, both bonds. You don't want to be stuck in a bad bond in the world, and also with stocks. So, this is the time where mutual funds can shine, clearly. I mean, they've been getting a bad rap because of all these cheaper alternatives, but I do in the end say, when you buy cheap, you get cheap. You're going to have to give up something of value because you're paying less for it. So never think that you're getting the same exact value for a lower price. You know the old rule, Jim, right? There's price, quality, and service. You can only get 2 out of 3. So if you look at it that way, that rule never changes in anything you buy. It's price, quality, and service. You have to give up one of those depending on the price you're willing to pay. So if you pay a higher price, you get quality and service, etc. So you can never have all 3 happening in your favor. And the same thing happens with investing and everything else. Sometimes it's worth putting a little bit more money on the table to get the quality and the service that you really need.
Thanks a lot for chatting with us, Richard.
I appreciate your time.
My guest has been financial consultant Richard Knowles of Knowles & Associates in Vancouver. If you have any questions for Richard, you can send them to Richard K, that's the letter K, at customplanfinancial.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We're also available on YouTube. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.